the news that happened, the NFP that happened on Friday was better than expected. So it was better than economists were expecting. I mean, they added more jobs. Non-farm payroll is like, jobs, the data of the jobs that are being added in the economy, aside from, farmers. So they added more jobs to the economy, and unemployment reduced. So it was good, but Nasdaq dropped, US 30 dropped. In that moment, gold also dropped. The DXY rose, and then GU rose, GJ rose, GU dropped rather. GJ rose, UJ rose, USD card rose. Everything just spiked, and it's so amazing because I was expecting every single thing that happened. Both GU drop rather, the rise on UCAD especially, but I missed every single thing. Like, I did not set the order.
Wow.
For some reason, I didn't take any of those trades except there was one account I was on gold on, and that was it. But UCAD especially was what I was looking at, because there has been news on oil, and everything. Oil has been dropping, and USD CAD, is in correlation with that. So I just checked it technically, and I knew this was about to pop. But because of NFP, I don't really trade the news, because when it comes to news, the actual report, once it comes out, it's not going to reflect immediately on the news. It's going to, most times it's going to do the opposite immediately. Then remember, fundamentals is the direction of the market. So then later on, it's now going to start going like the way it's supposed to go. But immediately it's going to do the opposite. So most people were expecting Nasdaq to buy, because the economy was supposed to do good. But which is what we are talking about today, interest rates. You know that they increased interest rates. So that was last week for the US economy. And GBP also increased their interest rates. GBP USD in the long run, GBP rather, the Great Britain pound, the currency itself, is going to is going to go long in eventually. But because it's pegged to the US dollar, so we are going to see what will happen to the pair. But GBP itself, that's the currency itself, is going to go long, because whenever you have interest rates increase like that, whenever they increase interest rate, the currency of that country is, will do well. So let's look more. So we are going to be talking about interest rates, and I have like 2 announcements that I want to share with you guys. And I'll do that at the end of this class. So quickly, I don't want this to be too long, so that you'll be able to watch the replay. And so when we talk about interest rates, can you see my screen?
Yes.
Okay, so first of all, to understand interest rates, you're going to have to get a little bit of understanding on what fiscal policy is and monetary policy, because this might be giving you economics vibe if you did economics in secondary school, and if you didn't do it, you escaped it and went to science class. Now you're doing Forex. Now you have to study the economy. So or government. So when we talk about fiscal policy is the economic direction that a government wishes to pursue. So once once a government comes into like, once they come into government and we have like a new government, they have like things that they've promised the taxpayers, they have things they've promised, everybody, like in Nigeria now, cassava.
Is it for beans?
Is it for beans? I'm just joking, but normal government, right? They have things that they promise. There are people, when it comes to tax and when it comes to the economy and what they are going to do to allow people's lives to be better. So this is the fiscal policy that they have. And then monetary policy is the actions that the central bank is going to take, because the central bank is in line with the government, right? They are working, their job is to make sure like money is flowing in the entire economy. And it is their job to help the government implement, their fiscal policy rather, not fiscal. So the central banks, they have several options that they use to affect the monetary policy, but their most powerful tool is their ability to set interest rates. That's why it is one of the biggest movers of the markets. And it's a very important news, and it literally drives the Forex market, because if you watched Forex 101 that I did, I explained in details about how we are trading for foreign currencies. That is exactly what we are doing in Forex. We are dealing with the exchange rates in currencies. So it's not necessarily like you are dealing with a particular economy, but the currency of that economy, what moves it and everything. And if you trade gold, you need to understand how it moves too. And if you trade US 30, you need to understand what also moves it. Does that make sense?
Yes.
Okay, so when it comes to interest rates, the definition of interest in school, we used to do like principal interest and all of that. I'm not a math person. So interest is the cost of borrowing money and the money that you earn from your savings. In other words, if you borrow money from a bank, the interest is what you pay for your loan. Right. So when you go to the bank, you borrow money, they say they have it's like 5% interest or 2% interest and stuff like that. So when you do have can you mute your mic? Hi. Welcome.
I'm sorry.
No problem. So when we do have interest rates is the cost of borrowing money. So when you borrow money, you have like interest on it. Interest is the return that you receive from the bank. So we get that. So the definitions, again, you receive your returns. It indicates like the cost of return of percentage of the amount that you are borrowing. If you are the borrower, the interest rate is the amount that you are charged for borrowing money. Just same things in different ways, right? So once if you are borrowing money from the bank, you always want the interest rate to be less. You always want the interest rate to be less because, you don't want to be paying plenty interest rates. But if you are saving money in the bank, you want the interest rates to be more. I don't know if does that make sense? Because the more like once you keep your money and then the interest rate is high, you are going to receive. So let's say you have $1,000 in the account and the interest rate increased from like 2% to 3%. So now you are able to withdraw $1,030 as opposed to $1,025. But if you want to go and lend from the bank, you are the one that will be paying interest. Does that make sense? Do you understand it?
Yes.
Okay, so now how does it concern you know, how does it concern us? So there's something called ripple effect. You know, and this has to do with when you take the fundamental analysis course, you would understand how everything lines up and how each thing affects one thing affects one thing that ends up you know, leading up to the central bank taking their decisions. So the central banks, their job is to, one of the things that they do is to loan banks. So they loan commercial banks. We as individuals don't go to central bank, right? We go to the commercial banks, we go to the financial institutions. So there's something called overnight rates, where every day they loan people money so that there will be money in the economy, right? They know that's their way of pushing money into the economy and making sure like there's sufficient liquidity for businesses to thrive. Remember when we were talking about liquidity in technical analysis, I explained that the meaning is when you have like money circulating, right? When you have money circulating everywhere, that's the definition. So when you say this is like there is enough liquidity, that means there is enough, you know, money that is being circulated. So they pump money into banks and then they loan them money and all of that. They charge interest on it, and it is the interest that they charge. Once they charge that interest on it, the banks will know how much interest to charge the people that are coming to them to loan money. And this loaning you know, business, if you live in Nigeria, you know that that's one of the major things that banks do. They look for companies, they send it's literally like you know, what they tell their employees, most people, to do. Because I know someone that works in a top bank, is like a top manager there, and one of the things that he does in his, you know, department is to make sure like people bring in people that need loan. So they go and look for businesses. They target like businesses, a lot of people, and then they make sure like they come to collect loan from their bank. So it's the more people come to collect loan from their banks, the more, you know, people will pay interest on it. So they are doing business. They are into business. Okay. So central banks, they use this relationship between the short-term rates. So short-term rates is the rates that they offer to commercial banks, right? So they use this relationship between the short-term rates at which it offers its loans and the interest rate that they charge banks as a way to influence the cost for the public to borrow money. So it's like they're watching how, you know, the more people come to borrow money, the more the commercial banks borrow from the central bank, and so on and so forth. So if they see like it's slowing down, that means the economy is slowing down, businesses are not thriving. So if I have a business and I want to expand my business, let's say I need about 20 million to expand my business, and I go and collect 20 million from my bank, obviously the bank would give me, and then, you know, with all the papers and everything, they'll give me the loan, and then, you know, they collect from central bank again. So it's like they know when people are using money in the economy, and I grow my business, I'm able to employ a lot of people to work for me, you know, even with expanding the whole place and expanding, getting a place, employing construction workers, employing people, just doing things, and then I'm selling things to people. So it's like the economy is moving, there is employment, there is different things happening. So the people that I employ, I pay them salary, I pay them their wages, and then they go and buy stuff. They go and buy rice, beans, cassava, and dodo. That meme is trendy. It's everywhere. So they have money to spend, and the economy keeps going, and that's why you see that consumers, we have consumer price index that monitors how the consumers are spending. So note that if the central banks feel that there is an increase in consumer spending, so they need to stimulate the economy. So it means that it can lower its short-term rates when providing loan to the banks. So yeah, that means that they are going to cut interest rates down. It's not going to be more. So that means, so let me go to the next slide. I think you are going to understand it as it goes on. Hold on. Okay. So if tightening of the economy is needed to slow down inflation, the central bank will increase interest rate. Okay, so here they want people to borrow more. So they will cut interest rates. They want you to be able to borrow more and pump money into the economy. This means I come and borrow money, the interest rate is small, come. But on this other hand, when they say they are tightening the economy, so if you are reading fundamental analysis and you're reading articles and they're like, oh, the Fed, by the way, is the Central Bank of the United States. We have BOE, that's Bank of England. We have BOJ, that's Bank of Japan, RBA, Reserve Bank of Australia. And each country has BOC is Bank of Canada and all that. And ECB is European Central Bank. So everyone has their central bank that is focused on their economy. So the Federal Reserve is not for everybody, even though they act like they are for everybody, but the Federal Reserve is affecting the US dollar and the US dollar alone. It's just that the US dollar is so strong and is the world reserve currency, and so many things are pegged to the US dollar. So many economies, they pay their loans, they borrow money, they do everything with the US dollar. That's why it has so much effect. So as I was saying, if the tightening of the economy is needed to slow down inflation, the central bank can increase the interest rates and make loans more expensive to acquire, which will lead to an overall reduction in spending. So they use interest rates to just control the economy. That's their job, just control the economy. Even though they are trying really hard right now, and we are actually living in financial history. It is happening right now. So when the central banks have a hawkish stance on interest rates, like Diana mentioned earlier, it means that they are increasing interest rates. So they are increasing interest rates. When they are dovish, it means they are reducing interest rates. So when they increase interest rates like that, it slows down purchasing power, which is what is happening right now. For the past 3 times that the Federal Reserve has increased interest rates in the United States, the prices of everything have skyrocketed like everywhere. And I think even Nigeria too has increased interest rates. So yeah, the prices of everything is skyrocketing. Everybody, GBP too, just increased interest rate. Why are they doing that? Recently, we all know that the world just is coming out of a pandemic, right? The pandemic took everyone by surprise. And at some point, there was no demand in the economy, right? There was no demand in the economy. People were not spending because we're all on lockdown, right? Y'all remember 2020, the year that we don't want to ever relive again. There was literally no money in circulation. So what the Federal Reserve did was something called quantitative easing, where they printed money. They literally printed money to the economy and then sent money to people. When they were doing that stimulus thing, that they were rolling out dollars was flowing. They needed people to spend so that the economy will, stabilize. So the economy stabilized, and then went up, and now inflation kicked in, and they still didn't do anything about it when inflation was really going high. Then Russia war happened, Russia and Ukraine happened, and then inflation just went up. So ever since March, the Federal Reserve has been increasing interest rates, and now at a rapid pace, because normally they're supposed to go like from 0.25 to 0.50. Now they are doing 0.75. They're increasing it at a rapid rate. When they are doing that, they are taking drastic measures. That means that the economy is really, really at a peak. We are heading to a peak period. They don't want to get into a recession, which they're already in. Because if they increase it too much, it means that they are avoiding recession. So, and investors will panic, everything. So how does it affect price? How this affects price is that investors, not traders, two different things. Investors, people that buy large quantity of currencies that move money from one currency to another in large quantities. They naturally look to currencies that provide the best return. If interest rates for a particular currency rises, the investors will increase their holdings in that currency to be able to profit. So when you put your money in it, you are not borrowing, right? So this is not for borrowers. Okay, so when you put your money there and then it increases, it's just like, if you had bought dollar, you exchanged your naira for dollar last year, it was around 400, I think, and now it's 650, or it's almost 700, or it's even 700. And you had done that. One of my friend was like, he was calling his auntie that, I told you to buy dollars the other time. Instead of going to open shop. I think she wanted to open a supermarket. So investors usually buy that currency. They usually invest their money in that currency. And what that does is it increases the demand for that currency, and it will cause it to appreciate in value compared to other currencies. But what that is doing, why did they have to increase interest rates in the first place for an investor to come and put his money there? It means that the economy was not doing well. We had unemployment. Okay, we have unemployment. We had so many things going on, inflation. And what does that do to the stock market? The stock market comprises of different companies that are running, right? They are doing business. Everybody, they are buying and selling cars. They are producing things. We'll use Tesla as an example. Tesla produces cars. They need to buy manufacturing, equipment. They need to do a lot of things. They need to pay workers. They need to do so many things. Right? If there's inflation, the cost of all those things are going to be expensive, and the customers that are buying their cars are going to be buying it at a higher rate. Customers might not be able to afford it during inflation, so their sales is going to drop, and Tesla is a large company. That's why recently, I think 3 companies missed their earnings. Earnings is when, at the end of the quarter, a lot of people, you come here and submit your report for the quarter, in the stock market. So if you are trading NASDAQ and US 30, you should also understand how it affects that, because in as much as this is good for the US currency, which has been making it to grow high, the stock market of that country, I'm using US as a case study. You can also apply this to if you are trading Canadian dollar, if you're trading GBP, if you're trading Australian dollar, or even New Zealand. So the stock market of that country is going to be a little, it's going to affect it. So higher interest rates attracts capital, the currency value increases, there is incentive to invest, but you know, you will spend less. So what the Fed is trying to get everybody to do is to stop spending. So right now, people are going to be opting out for necessities now. The people that used to buy, you know, the ballers that buy a lot of Lamborghini, you have 5 Lamborghini, 5 Teslas, you know, everything. You're going to reduce it. If you bought 5 last year, you're going to buy only 1 this year. And I actually saw it on someone's story. One of the stock traders that I followed, she said that she's cutting everything. Last year, she bought 3 wristwatches. This year, she's buying 1. Last year, she bought 3 designer bags. She bought 5 designer bags. She's only going to buy 2 this year and all that. So it's affecting everybody. Everybody is now like, you know, slowing down on their spending, and that is exactly what the Federal Reserve wants. So once they lower interest rates, it contracts capital, meaning investors don't want to invest there, and it's going to decrease the US currency, you know, and all that. Incentive to spend will come up because people are going to borrow more in the bank, and then money is circulating in the economy again. Right now, there is too much money that is circulating, and too much of everything is not good according to them. You know, so they need to be able to stimulate the economy, and then you know, they did quantitative easing, and now they want to, I'm not sure they started, but the Fed chairman Powell mentioned in March that they are going to do something called quantitative tightening. So, or something in regards to their balance sheet. So instead of printing out money or you know, writing that they have money, quantitative easing too is like putting it in their balance sheet that this is the amount of money they have. Is somehow legal. I don't know how that is legal, but they put it that this is the amount of money that they have. Meanwhile, like that's not the amount in cash, you know, so they print up like made up money. So they are going to do the opposite of that in this time. So just to be able to tighten the economy and put it in the balance sheet that, okay, the economy is doing well. So what this, you know, I think I've explained this and we've gone over it, like what central banks look at when it comes to increasing interest rate before they do that. So I already explained inflation, unemployment, and everything. So if an unemployment is high, the economy will struggle, you know, and you begin to see forex traders will begin to price it in. Those are the big boys, not retail traders, because retail traders don't move the market. They're talking about people, the hedge funds, the you know, financial institutions, and everybody that trade the markets, and large speculators. So and what do you use to track the inflation? You are looking at CPI data, which is the consumer price index also. So everything has like layers, and in the fundamental analysis course, I talked about, you know, I started with how to understand the economic cycle. We have like 4. We have the peak, the trough, recession, and everything. So you understanding each one will let you know, okay, this is what's happening now. We also have the risk on and the risk of environment. So you need to understand, like, this is where we are now. This is what the economy is doing now. So you won't be surprised when the economy is going a certain way. So, and I also, you know, put in here about what basis point means, because, you know, you'll be seeing everywhere that, oh, the Fed increased interest rate by 75 BPS. BPS means basis point. So this is a common unit of measure. I definitely don't like maths, but this is the definition. Common unit of measure for interest rates and other percentages in finance. So it's just like when we are saying how many pips did this move, like 20 pips, 100 pips, you know, this is it for interest rates and bonds and so many things that they use it for. So this is how you calculate it. if the Federal Reserve Board raises the target interest rate by 25 points, it means that the rates have risen by 0.25. So if it was at 2% before, it's going to rise to 2.25. So with this example, it was at 2.25. So if you add 0.25 to it, that's 0.50, right? So if you increase this 2.5 and they increase them by 25, then it increases to 2.75. And this 2.75, let's say that is the interest rate. At the end of the year, they will compare the interest rate at the end of the year to last year's end of the year interest rate. So sometimes you have year-on-year interest rates, and they will compare that. At the end of this year, I think they are going for 3 point something. If they exceed that, that's another problem. It's for the Fed. So they have to be able to meet up with that target for the interest rate to not be too high also. It shouldn't be too high. So they are working on increasing it. And if they should increase it by 100-point basis, that is not good. That is not good at all. It means like the economy is overheating. The economy is overheating, the inflation is everywhere. But at this point, the last thing that the Federal Reserve did was to increase interest rates by 0.75, by 75-point basis. So if the next one, they usually have their meetings every 6 weeks. So on interest rates. But during that 6 weeks, different Fed chairmen will be talking. Different people will be talking from the Federal Reserve and all that. So if by then they now reduce it and do 0.50, then you begin to see that, oh, there is progress. That means they've seen a little bit of progress in the economy. So it's going to boost people's confidence, in as much as it's not what people want, but it can cause the stock market to spike, to go up. But if we don't see any change, it means like the economy is still worsening. But for non-farm payrolls to actually come up, really good, not really good, but at least better than expected. For it to come up like that, that means that, okay, the interest rate increase is working and the economy is getting slowly getting back. I mean, that's one. We have CPI data coming on the 10th of August. So that's that. Do you have any questions so far? And was that understandable for you?
Yes, it was understandable. But I have a question, please.
Yeah, go ahead.
Please, is it okay if you can go back to the slide that talked about hawkish and dovish?
Oh, okay. I didn't realize. Let me see. Here.
Yeah. Okay. Like when we're talking about news and they say the news is hawkish, we say it's good for the currency, and if it's dovish, it's not necessarily that good for the currency at that point. But now relating to interest rates, hawkish now says like from the diagram we have that it slows down purchasing power for okay. How
Increase
I'm trying to
demand.
relate.
Sorry, I should have put D. So increase demand. Just do like a raps on demand.
Okay.
So, yeah, how is what?
Okay, so hawkish, that typically still means the interest rates drove up, right?
Yes, hawkish is just another term for increase in interest rates. So
Increase.
if they just say that, it's like Forex lingo. So if they say the Fed is hawkish on this, that means they are still standing on their increasing in interest rates. And if they say it's dovish, they have a dovish stance. That means they want to cut interest rates. So if you are reading an article that
Okay.
says that, oh, maybe it might not be the Fed chairman, maybe someone in the committee, and they're saying he had like an hawkish tone or a dovish tone. So you know that they are leaning towards increase in interest rates or interest rate costs.
Okay, thank you.
So Believe asks that, so the hawkish on interest rates is bad for the economy. Hawkish literally means interest rate increase. It's the same thing. We are increasing interest rate. Increasing interest rates, I think this is the slide that talked about it, that a high interest rate, it means interest rates are high. It is good for the currency, but yes, it's not good for the economy. Because in the economy, we want to be able to buy what we want. But when they increase interest rates in the economy, purchasing power is slows down. We're not able to flex, you're not able to buy houses. For example, the housing market, now that interest rates are up, and the US economy, they deal with credits and everything, and mortgages and all that. So, people are going to be paying more right now, right? So there are less buyers in the market. There are less buyers in the market. It's a seller's market for the housing market. So you already know there's one thing that I talk about in the fundamental course. Housing starts too is one of the economic indicators, because if a developer is going to want to build, like, let's say 50 units or whatever it is, they want to build duplexes, they want to build, and all of that, they want to build like a whole estate. They borrow money from the bank. If the interest rate is too high, they are not going to do it. It's not worth it, because maybe after they finish building, the economy would have bounced up and they would have reduced the interest rate, but the rate that they borrowed at is not favorable. They are going to be selling the houses higher than the market price at that point in time, or they're going to lose money. So people won't go and be doing business right now with real estate. You won't be building new stuff. Let's say it was before the interest rates are low, you see a lot of constructions going on. People are building, and building also, you pay people salary, you employ people, and at the end of the day, you sell the money, and just you sell the house, and those people that you sell the house to, they are buying furniture, they are buying things inside their new home. The people that are selling furniture, selling washing machines, selling gas cooker, all of those things, they all manufacture from somewhere. That's also another company. So things are moving. The economy is booming when the interest rates are low. But right now, people are not able to buy new homes because it's just too expensive. So does that make sense?
Yes. So basically, what does increasing interest rates definitely help to curb inflation, right? But then it affects the economy because spending power is reduced, at least for like that period of time.
Yeah.
So what does the economy now stand to gain? It's just in loss, or the idea is just to focus on curbing inflation at that point?
Yeah, they are just focused on curbing inflation. It will affect people. They don't they just care about the currency, about stabilizing inflation, about just keeping everything stabilized.
But if
but yeah.
Sorry.
Yeah, go on.
Okay. But if increasing interest rates would make the currency, does it make the currency weak or strong at that point?
Yeah, it will make the currency strong. Listen, high interest rates increases the value of the currency, which is why. So let me go to the chart.
Okay. So what in turn makes the currency stronger? when interest rates is reduced? Is it because investors are now putting in are now investing in large sum in that currency?
No, when they cut interest rates, the currency is going to go down. It will reduce the currency. It's just the things that are pegged to the currency that would increase. If you notice, gold is a commodity. It's a commodity on its own, but you know, whenever they increase interest rates, gold also goes down. But the currency for US is DXY. Okay. Oh, I actually wanted to send this to the Telegram channel. I thought I did. So we can see the dollar has been, you know, I went to the monthly chart, and for the past you know, months, 6 months, it has been really bullish, and they started in March. Although this started going up in March, but at this point, this was March here. It started in March and it has been going up. What do I want to say? What did you ask? Sorry.
Okay, I was asking, I asked how the currency benefits, like what really made it strong at that interest rate increase? Is it because investors now putting money because interest rates are higher?
Yes.
Okay.
Yes. I think I put it in one of the slides. The interest rate is going to invite investors.
Yeah.
Yeah. So the cost of the when they see, okay, I think it's at the end. How does it affect price? Investors naturally look at currencies that provide the best return. So, and I also mentioned that investors, not business owners, not
borrowers,
right? If you are borrowing money to do business, is different. That's not investing. Do you understand?
Yeah.
So it's different from me that I have a company that I want to borrow money, but someone else that has like euro, for example. So imagine you are living in Europe and you have like 100,000 euros, and the Ukraine war happened with Russia, and US just increased their interest rates. You would change your euro to dollar just to help your money from inflation, because you just like literally something just happened in the, you know, economy that is going to shake it. So if you have like $100,000 or even a million, these people we are talking about, they have millions of dollars, millions, they are transacting in millions. So they move all their millions from, you know, one currency to the other. Once US cuts interest rate now, they move it to another place that is juicy.
Okay.
And that's how they make money. So imagine you, let's say, like I gave the Naira example now, you had 1 billion Naira, turned it to dollars. I'm sure you would have 1.5 billion now from the 1 billion that you had in 6 months.
Yeah.
So,
okay.
Yeah, that's how it works.
I got it. Thank you.
Yeah. So, yeah, so that's it with the interest rates. And I mean, interest rate is one of the is an important driving force in the economy, right? So, which is why it's very important for us to understand it. But there are other things that affect price, and I know fundamental analysis actually confuses a lot of traders. So that's why I want to speed up my fundamental analysis course that I'm working on. So that's the announcement that I said I have. I'm going to, I've opened up the fundamental analysis where you are able to pre-order this. Let me put this in dollars. I'll leave it in naira. Fundamental analysis course. So you can pre-order it, and I put the date for 20th of April. So, I already have it recorded, and, it's in editing now. So we are going to upload it before then. So make sure you get it for this 50% off, because normally it is actually $150. But now I just said, okay, let's cut half the price for those that want to pre-order it. Yes, it's broad. It's divided into 7 modules. Where we are going to be talking about the economic cycle, things that affect it, and all that, right? Is it here? Okay. Yeah, economic indicators, intro to FA. Then I also put in there how to trade with the news, how to not trade with the news, when to sit on your hands, and how to interpret what you are reading in your Market Watch, your Bloomberg. I don't watch Bloomberg. I don't watch CNN. CNN, don't watch CNN. Don't watch CNN. You will not know. I don't watch, all of those things, except you just want to do it for fun. But for me, it distracts me. I just go ahead to read on, I also added the places that I read news, read really important data that almost everybody don't. And one of those places is like the federalreserve.com, .gov.com. Then you go and look at the statistics where you see past interest rates. You are able to now think like an analyst. You can decide to do fundamental analysis and peg it with your technical analysis. That way, you are able to understand what is going on, right? But you can decide to not do fundamental analysis and focus on technical analysis. Technical analysis is just showing you like, places that fundamentals is happening. And you don't use fundamentals to enter your trade, except you are like a position trader. You don't use it to enter your trade. This is just going to help you to understand what is occurring and how to position yourself better. If you had known about this in March and you know how to use it, literally the USD card trade that I wanted to trade was because of fundamental knowledge on oil. Even though normally my fundamentals on oil is for it to be bullish, but things happen. So I literally just saw the news, I think on Wednesday. This week was weird because I was seeing trades play out and I was just not trading for some reason. I missed everything, which I shouldn't be doing right now. Right. And we had this huge spike on Friday. Because oil is going down. You want to read about oil. So oil has like Saudi Arabia, which I also included in the course because I talked about 5 major economies: the US, GBP, JPY, Canada, and then oil, and then gold. What moves gold also? So you can pre-order that from now to then. As soon as it releases, I'm going to remove this slash price and then leave it at the original price, except my team says like we should do a discount or something. And then the second thing is, you guys are actually the first people to hear this. I already have this out and I did this today actually. The secrets of successful traders. You are the first to actually see this. If you follow us on Telegram, you see that it has not been posted there. I have been writing this for like forever. And I'm just like, I got it out of draft and it was in editing and I had to tweak a few things. But, it's out now, The Secret of Successful Traders. And I even had to read it recently for myself. Like when I read it, I was like, wow, okay, I took pen and paper and I was like, this, and this, let me redo this. Because I think I told, my trading circle that I'm in a space where I'm restarting. So it's like a reset. So I went to read it again and I saw the points that I put there and I wrote them down, and it really helped my mind shift. And one of the reasons why I wrote this is because I saw like a lot of people that understand the charts, understand how to trade, don't really know that most of the things that makes people successful is in the things that you are not shown, right? It's the things that you are supposed to know, but you don't know. So I've written them in this book. So make sure you get it. This is not pre-order or anything. You can download it right now and get it immediately. We're going to start, promo for it and all, but you can be the first to like read it. Going into the new trading week, reset your mind and everything. And yeah, we also have here the signal service is open. Is open, and we are going to do promo for that also. If you want to join signals, it's called Secured in Pips. I just realized that anytime I send signals, I'll be like, oh, 50 pips secured, 100 pips secured. I think Yejide and Diana can tell you, like, I write, I don't know, then I didn't know why I was writing that, but I was like, oh, okay. The Holy Spirit was just like, why not secured in pips? And you can call it SIP, so a lot of people don't have time to be checking the charts. So as I'm trading, I'm sending the signals for most of the trades that I take, and I'm going to watch extra carefully. It's not 100%, that's why it's 85% accuracy. I actually counted how many trades we've won and how many we've lost over the past like 2 months or 1 month that it has been opened. And now we are just making it public. So go ahead to join in. It's a monthly subscription. If you don't have time to check your charts all the time and you just need signals. And I'm also working on making the signals, for London session and for US session, or for US session, because I mostly stick to London session. So most times you already know that signals will come between this time to 10 a.m. and you prepare for that. If it's not coming today, it's not after like 11, just close. It's not coming today, right? And you'll be able to time it when I am, actually sending the signals. So you can do that also for your account. So those are the things. I'm going to put the link in description on YouTube, and I'm going to start creating content for it because, yeah, it needs to be done. So you guys, fundamentals course, signals, and then the ebook. So, and that's it. I'm going to send my chart, my trading charts, what I'm looking at this week. Most things played out. Let me share my screen again. Most things played out for last week. I didn't have UCAD on the leaks. I told you guys I was looking at gold. I was looking at NASDAQ. NASDAQ just started actually. The week was choppy. But perks of being in Nigeria, no, they're not accepting my card. But anyways, I had this play for NASDAQ last week. And we just had like the first move, even though we had this buying move here. Nothing was really clear. Maybe that's why I didn't really trade this week, but now we have like a break of that. I'm expecting right now for this to break and retest this trend line. Although I will, when I'm trading this, I'll go to a lower time frame to get intricately what it's really doing. So I will send this as well. And then gold was really bullish. And remember last week I said that I'm going to wait, and if I see a bullish move, I'm going to take it, right? And we were around this area here last week. We had not hit this second take profit. So I was watching for that to hit, and I knew that we were around a monthly level. So gold, I didn't really play with because I know it's supposed to drop, but we still had a few things up there, and it did go to that monthly level, and I'm seeing liquidity. So I saw liquidity on Friday. That's why I didn't really tamper with it, but it's dropped. So this week we are going to watch for a further drop on gold. GJ and EJ, on the other hand, played out perfectly, although not on the exact days, but you can't tell the market when it's supposed to play out, right? But they did got to a daily support zone and then moved up. Our next move here is to wait and see what price is doing, because we are at resistance levels and all that. So I'm going to send signals to the signal group when I see what I want to trade. And if I don't see it, I'm not going to trade it. So that being said, I've talked a lot this night about interest rates. And you guys should have yourself a good night and a good trading week ahead. If you don't have any questions,
you very much.
Yeah.
Thank you.
Congrats on the books.
Congratulations.
Thank you.
Congrats on your book.